Welcome to Bitesize Legal, where we tackle legal issues one bite at a time. My name is Drew Jenkins, and I'm an attorney licensed in Georgia and Alabama. And today, we're taking a bite out of taxation of investors. We are continuing with our series of starting your new business to help ring in the new year. We've already discussed starting your new business as a sole proprietor, a general partnership, and a limited partnership. And before we move on to any of the registered entities, I wanted to take a moment to discuss the different tax consequences of being the owner of a business versus being the investor of a business. And this is a good starting point. So if you're an employee, you are used to seeing a withholding taken out of your paychecks called FICA. 7.5% is paid by you, 7.5% is paid by your employer. If you already have your own business and you are actively involved in the management of it, then you know that at the end of the year, you will owe an additional 15% in what is called self-employment tax. So even though you don't pay FICA, you will pay self-employment. And for those of you paying attention, you will see that 7.5 and 7.5 is 15%. But if you are merely an investor, meaning that you earn passive income from investments as opposed to being involved in the management and operations of the entity, then you're treated as essentially earning income from stock, which is not subject to either FICA or self-employment taxes by any of its various names. This means that a person who earns their money through their investments is able to take home an extra 15% more than those who earn it through actual work, which means you should be seeking to increase the number of investments that you have instead of simply working harder. And as you will learn later in the series, there are ways to do that through structuring your entities. So for the moment, if you are running a business with a general partner or you are the general partner, then you are involved in the day-to-day operations and you are considered to be in the business of, and you are considered to be actively involved. All of these terms have very specific meanings under the Internal Revenue Code, and thus you will owe 15% in self-employment tax on all the money earned by your partnership. However, if you are merely a limited partner, invested in a limited partnership, or you are invested in any of the registered entities in a limited capacity, such as another limited partner, or merely an investor, or simply a shareholder of a corporation, then you are considered, and you are not actively involved in the day-to-day management or operations of the company, then you will maintain the same position of that as a mere stock investor. And you will be able to keep an extra 15% of the income earned from those particular investments. So, the big picture here is to try and structure your income in a way that maximizes profit. And then after you've done that, you want to look at minimizing taxes. And so the way to minimize taxes is to make sure that as much of your income that is maximally profitable as possible is also going to be taxed at the lowest rates or at the investment rates. So as a limited partner, you are receiving tax benefits above and beyond that than if you went in as a general partner. Or if you are investing in an LLC, you are taking what we will discuss later is a membership interest. You are effectively a partner if you're taxed as a partnership. You need to make sure that the accountants know that, hey, I'm not actually involved in the day-to-day operations. I am simply a limited partner in essence and need to be treated differently for tax reasons. Now, this can be done under LLCs, and if you receive a K-1 at the end of the year and you notice that you are not treated in this way, then you need to reach out to the company's accountant and ask that they reissue the K-1, that they adjust the tax schedules. This is something that is frequently done if the company's accountant is not paying attention and is entirely normal. If you're invested in a corporation, it's very simple. If you're a shareholder, you are considered to be a passive investor no matter what. So congratulations, you are going to get the tax treatment that you seek. With S corporations, we will talk about those later, and I will hold that back just to make sure that you're watching. But that's really what you're looking for here. And I said I just wanted to take a few minutes to take a break from walking through the entities and use this portion to talk to you about the tax consequences of your business entity choices. So we know that if you are operating as a sole proprietor, you're just out doing business, then it's all going to be taxable to you. It's going to show up on your personal tax return, right? There is no K-1 issued. You are the business, and so it's personal to you. You're going to pay self-employment tax on the income that is earned by the work that you actually do. If you have a general partnership, there's going to be what's called a Form 1065 return filed with the IRS, and you will receive as a partner a K-1. Being a general partner, you have the ability, whether you choose to exercise it or not, to actually operate and make day-to-day decisions, and you will be taxed accordingly. However, with the limited partnership, you may be a general partner, treated same as a general partnership, or you may have this special classification known as a limited partner. So not only do you derive the benefit of having limited liability as a limited partner, but you also derive the tax benefit of not being encumbered by an additional 15% self-employment tax because you are not actively involved in the operations of the business. So this is certainly something to keep in mind. Now, next week, we're going to move into corporations, which will be the first of our registered entities as it relates to Georgia and Alabama. And from there, we're going to be talking about all the entities that are both newer in creation time than the partnerships. They're going to be treated differently for tax purposes, and all of them for Alabama and Georgia purposes are going to need to be registered with the state along with appropriate annual filings. So I hope you found this useful, and if not, at least enjoyable, and I look forward to you joining me next week on Bitesize Legal.